What is going on, investors? Back again. Time to talk about the Walt Disney Company, ticker symbol DIS. We see during the regular session down fractionally, kind of like the market, but in the after hours after reporting earnings, up big time, up about 5%. This concludes a monster run that this stock has been on over the last few days or so. We've seen a rotation out of kind of the stay-at-home stuff or the stuff that's been working all year into companies like Disney, which has been beaten down a little bit. But as we jump over the stock chart, this stock is about to approach what is considered all-time highs for this one. So we'll see if that is justified when we jump into the numbers. Now, like I said, they just reported earnings after the bell. Everything looks pretty good from, a perspective of where we're at, with the health situation and everything that they've got going on with movie theaters basically being closed, with some of their parks, especially out here in California, being closed. But the positive of things like their direct-to-consumer Disney Plus, ESPN, things like that doing relatively well. So we've seen revenues overall fell 23% down to $14 billion. I'll show you the numbers here in a second as well. And they have a continuing operation swung to a loss. We're now losing $580 million when we made $1.25 billion last year. So they're losing money. This is why they eliminated, I think they paid a semi-annual dividend, and that is now gone, although it was a relatively small amount of money. So I don't think it necessarily impacted the stock that badly, but everything looks pretty good when you start to look at the operating by segment. Media networks was up 5%. The parks was obviously down huge, about $1 billion, but the studio entertainment was down also 61%. But the shining light that everybody's kind of looking at is the direct to consumer. That was up big time. So everything looking good, pretty there. Let's go on to the numbers here. So we've got the revenue here. We've got their media networks. We've got all the things here. So this is kind of interesting. We've got the quarter ended here. We've got the year ended here. So it's a fiscal year that just ended for Disney. We see the media networks for the quarter actually ticked up nicely to $7.2 billion. We see for the year up 14%. That's solid. Then we see the parks, experience, and products. Interesting quarter where I believe this is this is everything except for California. I believe most of the parks or some of the parks are open. The one out here in California is not open. So that actually gives you an idea that I don't know if Disney actually breaks this out, but this actually gives you like an idea what kind of revenue Disney does ex California. So if we have more closers out here in California into next year for whatever reason, maybe health situation, maybe the fires or whatever. So this is kind of an interesting way if you ever want to really dissect Disney's numbers, you kind of get a read here on ex-California here. So went down from 6.6 down to 2.5. That's a 61% decline. We were down 37% during the year. All things considered, it's not that bad. I know it's $10 billion, but down 37% in a year where as rocky as this one, not that bad. If they can get things open back up, things should look pretty good there. Studio entertainment, obviously down big time as well. You got most movie theaters still closed and things like that, down 52% in the quarter. But look, down 13% in the year. Again, they just held things together, all things considered. These are not great numbers. Nobody would have expected this. But again, now that we know what has happened, not too bad. Now, direct to consumer, these are phenomenal numbers, up 41% in the quarter, 3.4 up to 4.8. Take a look at this. So even in we'll take a look at this. Like this is like a normal quarter, I guess, or a semi-normal quarter for the parks products when everything is open, nothing's wrong. This is very quickly becoming the second largest business. My guess is by next year, even if things were to get fully opened with the parks, you'd probably have some renaissance with that. People going there, flocking there, having a lot of fun there, but the direct consumer space will probably become the second largest piece of Disney's business very quickly. It's already taken over studio entertainment and will probably overtake the parks. And look, it might overtake media networks at some point. So that's super exciting. If you're an investor, you see in the year, it's up 81%, up from 9.3 last year, up to about $17 billion. Now, that is the revenue side. Here's our operating income. They don't show us it by the cost, but you could back into those numbers if you wanted to. So media networks made 1.8. That's basically flat, 5% year over year. But you see for the full year, actually up 21%. So that's solid. We see the parks and entertainment group that swung to a loss of about $1.1 billion. Compares absolutely disastrous to the previous period where we made $1.4 billion. You see for the full year, not bad. Okay, they basically had a break-even year. Take a look. We made $16 billion for the year ended, and take a look. We only lost, I say only, $81 million. That's not bad. Okay, yes, it would have been great to make $6.8 billion like we did in the previous period, but how bad the situation was, they still made money. So if we can get this park opened up here in California, because you can annualize this number out, you're at about $10 billion, because times this by 4, you're at 10, $11 billion. That's not anywhere near where we're at for a full year. So they're probably, if we have the same type of situation next year, you're probably at a little bit deeper loss, but it's not that bad. $81 million to a company like this is basically a rounding error. So it's not bad at all. Now, studio entertainment, we see in the quarter down to $419 million. That compares really negatively, down 61% from the previous period, down from $1 billion. But you see for the full year, again, paints a little bit better story. We're at 2.7 down to 2.5. So not bad at all there. I mean, it was basically flat on the studio entertainment. Really nice. Now, the direct-to-consumer has not hit that tipping point yet. So we lost 751 in the previous period. We lost 580. So you saw it accelerate here by 41% on the growth, but we only saw our operating income accelerate by 23%. So they still need to grow this by quite a bit, but it's basically at a tipping point. They can either raise price at some point, which I definitely think they'll do, or they obviously keep adding users. I think they'll do a combination of that. Disney's going to be able to keep adding users, probably acquire more content, obviously create more content, but they'll be able to raise the price at some point, and that will accelerate this operating income from the digital side. You see, for the full year, we lost actually more money. We went from 1.8 up to 2.8 loss. But again, a lot of investment there, probably a lot of advertising when Disney Plus got launched and ESPN Plus and things like that. They do a lot of advertising for that. And so that's kind of interesting as well. Let's move over to the stock chart. Let's see what we got going on there. We know Disney's well capitalized. They're not paying the dividend. Everything's okay from a balance sheet perspective. I don't need to waste your time with that. We see right here, right where my cursor's at right here, we're at about $141 per share. You see in the after hours, we're up pretty big. It's traded off a little bit. I think it was up closer to 5%. But here we are. This is a monthly chart. I put us on a monthly chart because I want to show you, here's our top. Here's our top with Disney, and we're actually getting pretty darn close. In fact, this wick almost came all the way up to our record highs with the stock right at 152. So this stock's about $10, $12 away from hitting its record heights. I think what's happening is investors are pulling forward a positive 2021, positive for the parks, positive for the movie theaters, positive for Disney Plus, positive for all the other networks as well, especially ESPN, which relies on sports. Those likely won't be as disrupted as they were last year. And so, who knows what happens? I'm already long Disney. Full disclosure, I'm already long Disney. I'm not looking to add shares at this level. Now, what could definitely happen is this stock could come up here to these all-time highs and kind of blow through them, come back up, make even higher highs up in near 160, 170 maybe. To me, that's not an attractive place to buy the stock. Any kind of pullback back into this 131, which is about $7, $8 lower. Say we get more shutdowns. Say we get really bad news in that sense. This stock would definitely, I think, maybe pull back a little bit because, like I said, I think investors are pulling forward a really solid and kind of quote-unquote open 2021, which I think that's still in the gray area right now. I think you could almost flip a coin whether or not we have some extended shutdowns into next year, which would affect the park, especially if it was like a mandate from the federal level. That would impact the Florida parks. That would impact all the parks, not just out here in California, where the rules tend to be a little stricter in terms of reopening. And so I think some of that is pulled forward. So if you got a pull back down here to 131, we see here, this was a nice level to come in here and buy the stock. Any pullback deeper than that, you're probably at 119. 119 is probably even better. Personally, like if I were to allocate, let's say I had 1,000 I wanted to throw at Disney, a pullback to 130 would be 1 or 2 shares. A pullback to 120, I'd be more aggressive, probably 4, 5, 6 shares at that point, because then your downside is your biggest downside on this stock is probably down here, retesting these lows down here. That's at 95. And so the odds of us getting back down into that range, I think, is relatively slim as long as the news keeps getting positive on the vaccine, the reopenings, that type of thing. We've got a ways until we switch administrations potentially, and if that happens and there's more shutdowns, well, this one could pull back a little bit. And so that's something I would keep an eye on. But we're in a defined uptrend. The stock's gapping up in the after hours too. We're approaching these all-time highs. I will be watching closely what happens here, because if you break these, look, there's nothing above here in terms of supply or demand, so stocks can run when they get that high. And if Disney can really put some heat behind their direct-to-consumer, talk about the profit that they might make next year, maybe talk about a price range or more direct-to-consumer movie operating, things like that, things could get really strong for this stock in the short run. I just tend to not buy when we're ripping to all-time highs. That's just me. I'll let you decide what you want to do. So that's Disney for you. Hopefully you guys enjoyed this one. We'll be back again soon, including tomorrow with our FANG stock recap show. Good luck with your investments.